Hello, everybody. I'm Bill Bell, Vice President of Advanced Sales with Penn Mutual. Thank you so much for joining us here today. Now, it is my pleasure to present you with an overview of what was formerly called the One Big Beautiful Bill. We call it the Triple B for short, so I'm going to refer to it throughout this video as the Triple B. But essentially, this was a wide-ranging bill that is going to be affecting tax and spending policy in this country for the next several years, and in some cases, well beyond that. Now, when you watch this video, you're going to walk away with a few different things. First of all, you're going to find out what happened. Second of all, you're going to find out what's in the bill itself. And third, you're going to find out how the bill affects life insurance planning going forward. There are a few pieces that we did want to call out right out front. In many ways, this bill is an extension of the Tax Cuts and Jobs Act of 2017, or TICJA for short. The 199A deduction for qualified business income was definitely extended going forward, which I know is important to a lot of financial professionals. And we have a plan of attack for providing information to our financial professionals with a number of different written pieces that the advanced sales team at Penn Mutual is going to be developing over the next couple of weeks here. But let's dive into it here. So first of all, what happened? Well, the president signed the bill on July 4th. It was a hurried process, but they got it done. It actually was a little comical because at some point, the Speaker of the House was actually looking for members of his caucus, trying to find them to vote on a procedural act on Wednesday, the 2nd. They got it done. They got it passed. The president signed it on Friday, and it is now law here. There was some disagreement from Republicans in regards to some of the spending provisions in the bill, but there was a lot of consensus in regards to most of the tax provisions that we're going to discuss here today. And some of those provisions actually become law here for the 2025 tax year. So, for example, the SALT deduction, which I'll mention here in a little bit, actually is in place for 2025 here. So when those of you that are going to take advantage of that deduction go to do your taxes next spring with your CPA, you will be able to take that deduction here for the 2025 tax year. So what's in it? Like I said earlier, in many ways, the Triple B is an extension from a tax perspective of the TICJA rules that we've been working with for the last 7 or 8 years here. I did want to start with talking about the transfer tax exemption and transfer taxes in general. So TICJA put in place a $10 million exemption and indexed it for inflation going forward. What the Triple B did is it basically just took that 10 million and replaced it with $15 million per person, indexed it for inflation, and it made it quote unquote permanent. And when I say permanent, that just means that it is in place until is changed again at some point. So I'll use air quotes around the word permanent in regards to the permanent nature of all of the aspects of this particular bill here. Now you might be thinking, well, 15 million is a lot, but it's 13.99 million this year in 2025. So it's really not that big of a departure of where we are right now. And it is permanent, and that's going to have a big impact on planning for a lot of people. We'll talk about that in a little bit here. The 199A deduction, the qualified business income deduction for pass-through entities, was also extended on a permanent basis. There was some discussion about making that a 23% deduction at some point. They wound up at 20%, which is where we are here today. Again, they did make that they did make that permanent, so we do know that we will have that for the foreseeable future. They did, of course, keep the indexing for inflation for the phase out for the businesses that do have phase outs associated with their 199A deduction. The personal brackets remain the same. We still have a 37% top bracket, 10% lowest bracket, so those aren't going to change. We do have indexing for inflation for when you qualify for those brackets, and that is permanent as well. So we do not have any sort of reversion to the 39.6% bracket that was part of the TICJA back when it was put in place in 2017. The SALT deduction, which is a big deal for those of us in California or people in New Jersey or New York or anywhere that has kind of a robust state or local tax system put in place. for anybody that has a robust state or local tax system in place. What they did was they made a $40,000 deduction for salt. So a huge increase over what we have here today. Today we have $10,000, or at least we did have $10,000. The $40,000 actually is in place for the 2025 tax year. However, there is an income phase out starting at $500,000 of modified gross income. Starting at $500,000 of modified adjusted gross income, MAGI for short. And that provision actually expires in 2030. So the salt deduction, the increased salt deduction, will revert back to the $10,000 that TICJA put forward back in 2017. So that is not a permanent piece of tax law. And then one thing that got a lot of discussion was a big part of the president's platform when he was out on the campaign trail last year was no tax on tips, no tax on overtime, no tax on Social Security. I'll spend just a couple of seconds on each one. For tips, basically for people that receive tips as part of an occupation in which tips are customarily and regularly received, there is a $25,000 deduction available for those people. There's an income phase out for single filers at $150,000 of MAGI, $300,000 for joint filers. This also expires in 2029. So again, not permanent tax law. For overtime, there is a $12,500 deduction available for qualified overtime received by an individual in a given year. This also has an income phase out starting at $150,000 of MAGI, $300,000 for a joint return, and that also expires in 2029. And then you'll see a lot of stuff about no tax on Social Security. In part, that's true. In part, that's not necessarily true. What they did is they gave an additional $6,000 standard deduction for anybody over the age of 65, which of course is going to reduce the tax burden associated with some Social Security income. The income phase out for that is actually a much lower amount. It's $75,000 of MAGI, $150,000 for a joint return, and this also expires in 2029. So that no tax on tips, no tax on Social Security, no tax on overtime, those all expire here in about 4 or 5 years. So what does that mean for advanced planning? Well, reality is it doesn't really have an impact on what my team does or what a lot of life insurance specialists focus on here. We knew that there was probably not going to be a reversion to the sunset that was put forward by TICJA at some point in the past. We knew that we weren't likely going back to a $5 million transfer tax exemption. We knew that the 39.6% top income tax bracket probably wasn't coming back. So we've been prepared for this, and all of the planning techniques that we've been utilizing, whether it's estate planning, business planning, retirement planning, charitable planning, whatever the planning needs were, they're still going to be very relevant going forward in a post-BBB environment. So the things that we've been talking about, whether it's flexible estate planning with slats or ILETs, or putting in place non-qualified deferred compensation plans, or executive bonus or buy-sell planning for businesses, or putting in place a cash balance plan, or utilizing life insurance as a well-rounded retirement income portfolio vehicle, those are again still very, very valid going forward. And the BBB doesn't affect those really at all. So I would say status quo from an advanced planning standpoint. I think that the things that we've been talking about, things that you as an audience have been focused on, are still going to be relevant in the planning structures that we're going to be dealing with for at least the next 4 or 5 years here. So what are we doing from an advanced sales perspective to provide you more information? Well, we have a robust plan. In addition to this video here, we have some written pieces that we've already written. They're currently in the development stage here. One, we will have a client-focused FAQ document that's going to be out here within the next couple of weeks. In fact, I think when we air this video, it will be out the following week here, so keep an eye out for that. We will have a podcast with Jen Fox from Finseca, who was on the podcast earlier this year. She's making a return appearance to kind of talk about what ultimately happened in Washington, what was in the BBB, and why that's important for the life insurance industry. And then we have one of the blogs that I write that will be available here towards the end of the month. comparing what I thought was going to happen with tax reform with what actually did happen. Shockingly, you will find that I was pretty darn accurate in regards to my predictions, but you'll have to wait to read about that here towards the end of the month here. A lot more to come on this. I did want to leave you with our contact information in advanced sales at Penn Mutual in case you did have any questions or want to know how the BBB is going to affect the planning that you are considering for your client. You can reach us by calling 800-818-8184 and then hitting option 8, or by emailing us at advancedsales@pennmutual.com. Again, advancedsales@pennmutual.com. So with that, I'm going to wrap it up. Thanks so much for joining us here today. Look forward to talking to you soon.